Hey everybody, welcome to another edition of Weeds Weekly. And this week, what do we have? Will inflation ever get in line, right? Last week was supposed to be a really easy, non-eventful week. And boy, were we taken a little bit by surprise. So we're going to talk about that real quick. We're also going to talk about we cannot fall for the banana in the tailpipe yet again, right? The old Eddie Murphy, Beverly Hills, no banana in the tailpipe. So we're going to discuss that really quick. We're going to talk about all roads lead to inflation. And then we're going to talk about what happens. We need to move some products, so we need to shine. So let's dive in what happened last week. And last week we anticipated not many fireworks. And to be honest with you, there weren't many. But the big thing that we need to understand is, once again, I say it all the time and then we fall asleep, is that all data points mean something. And we had services and manufacturing PMI last week indicate growth, and therefore we saw rates creep up and end the week higher for the week. So the big question really was that I think we gathered from last week is, when is inflation going to come down? All eyes are on inflation. Will it ever get in line? It seems as if the consumer confidence has been pulling back. It seems as if jobs are pulling back a little bit, but it seems as if inflation just keeps chugging along. It's becoming more than persistent. It's becoming a norm at about 3.4%. And that, for the overall economy, is not a good thing. So what did we learn? So much for sleeping on the job, right? No more of that. We can't just take kind of weeks off, so to speak, and think that nothing's going to happen. Every data point means something in today's marketplace, especially when traders are trying to figure out exactly when the Fed might do that first Fed funds rate cut. So we need to be really on our toes and there for our clients and helping them really navigate this really tricky environment that we're in right now. And what we saw, once again, like I said, is that services and manufacturing PMI are indicating that we're in growth mode. They both showed over 50%. That means that they're in growing, which is very bullish, which is why we saw the rates get pushed up. So we need to make sure of that. So coming up on this week, we got the consumer confidence numbers that are coming out. I think that's going to be a pulse for the health of the economy and what's going on. As we've been seeing, the consumer has been pulling back. Since the start of Q2, the consumer confidence, consumer spending, retail sales last week, they've all been on the decline. However, should we see something like that change, I think that's going to be a real indicator but I think it's going to be a short blip. And why do I say that? I think it's because we're coming into summer, and what that means is there's graduations, right? Major events that are happening on. And this is across the board, from now we celebrate somebody graduating from 4th grade, 5th grade, whatever grade that they're in. You got high school, you got middle school, you got college graduations. I think you're going to see that the consumer confidence picks up a little bit given that. However, I think it's going to be a short blip, but it's going to cause interest rates to rise. So we just need to be very clear on that. And as we head into this week, the big thing, once again, back to Eddie Murphy, we do not want to fall for the banana in the tailpipe. We cannot be sleeping on the job. So we need to be very astute of what's coming at us. And the other thing that I think could be a potential big mover for this week is core PCE. So it moves out food and energy from the inflation number. But what it's going to do, it's going to give us a really good broad base of what is happening in the overall economy. We know food and energy are going up. We live it every day. We go to the grocery store. I walk out with a bag of groceries. I'm like, what just happened? How did I just drop $70 in this bag? We see that. We feel that. We see it in our bank accounts. We feel it in our budgets. We see it when we go to pump gas, right? We were down $2 a gallon, slightly over. Now we're $3.20 down here in Texas. And I know, in traveling, we got parts of the country where we're $4, $5. So we can feel that. This core PCE number is going to give us a little bit of an indication of what else is going on out there. Where are the big ticket items? How are prices on those? Are those showing inflation also? Or are we going to see a slight pullback in those numbers, which is going to equate over to food and energy? So I think those are kind of the two big movers. And then everyone is on pins and needles for when the Fed is going to change the Fed funds rate again. Everyone's got their money now on September. If you recall, yours truly indicated July, way back in Q4 of last year. I'm beginning to think that if inflation remains as persistent as it is, even though I believe that the Fed's in some way going to change its rhetoric for a 2% soft landing, and I think they're going to elevate that to 2.5, maybe 2.75, and indicate that while they wanted to see the 2% target rate, they feel with the growth of wages, the job market, and so on and so forth, that they feel comfortable at that point in reducing the Fed funds rate. However, if we continue to see these numbers that across the board are showing inflationary numbers, like a growth in the services and manufacturing sector, I don't think we see any Fed funds rate cut. As much as I believe that the Fed, as in every piece of government, is political, I think there's a good chance right now we don't see anything prior to the election. So I want everyone to just be kind of ready for that, because I know right now we're anticipating that to come. And I think we just need to be honest with our clients and let them know that, look, I think for the remainder of this year, we're going to be hovering right where we are. I think we're going to sway a little bit. We're going to have our ups and downs and so on and so forth. But make no mistake about it, we are high sixes to mid sevens on interest rates. That's just where we're going to be. So it brings me right into this. And my point and my thought for the week is all roads are leading to inflation. I mean, if you look at the three things that the Fed is really focused on right now, they're looking at consumer spending. And this is why we're seeing, even in these off weeks where we're having very little data, we're seeing significant movement in interest rates where they're going anywhere from 1/4 to 3/8 to 1/2 point higher or lower, is because all roads are leading to inflation. It's all inflation based. So any data point that is showing growth indicates that there's going to be more money chasing fewer dollars. Companies are growing. They're going to hire more people. That is not good to fight inflation. So what you're seeing is traders are basically saying, whoa, that means the Fed's not going to cut. That means that there's no reason for interest rates to come down. Interest rates need to go in the opposite direction. Interest rates are going to need to increase, and that's the long-term outlook. So that's what we're seeing. And the three, Kevin. The three things that the Fed is really focused on right now is, number one, is obviously the consumer. What is the health of the consumer? And I think that has been in our favor as of Q2, right? We're seeing consumer spending pull back. Again, I think if we see any spike, what that's going to be is a bump in the road right now. We're coming into summer. You're having seasonal changes and you have all these graduations. I think that's going to be temporary. So I don't think it's to set off any alarm bells. I wouldn't get all concerned about it if we see consumer pick up speed a little bit and confidence and all that, because I think the overall weight of the inflation is eroding the basic American out there, and I think that's going to long-term play itself out. So in the long run, I think that's good for rates that the consumer continues to pull back. The other thing is jobs. Jobs is a big one. And next week, we have a huge week as it pertains to jobs, right? We have the JOLTS, we got non-farm payrolls, we got initial jobless claims, you got ADP numbers. I mean, next week is the gorilla of the jobs report. And we're going to know next week where that stands. And why jobs is important, because, right, again, it's the same concept as the consumer. If companies are adding more jobs, they're not feeling the tightening of the Fed. They're moving along. They're feeling great. They're hiring people. They're increasing wages. Once again, it's more dollars in the system chasing fewer goods. That's what causes inflation. And it just continues to perpetuate itself, and with no ending in sight, and with the Fed's target rate of 2%, it just keeps getting pushed back to where it's not going to be attainable under these current environments, which means, what does the Fed need to do? Do they have to go back to increasing rates again? And then you have services and manufacturing, and I just think overall growth, noticing that growth. And I think the biggest culprit here is our own government. Our own government won't get out of its own way. They continuously keep spending money on all these projects, whether it be infrastructure. And don't get me wrong, do we need some of these projects? 100%. But from giving away freebies to illegals, giving away freebies to student loans, forgiving those, It's just pumping more liquidity into the system. It's increasing the debt, and it's creating a problem. The Fed can't get ahead. The Fed can't get to where it wants to go if over here in the corner you have a kid who keeps acting up. And that's our federal government with the way it keeps spending money. So it's going to be really interesting to watch, especially as we're coming into an election. But I think the biggest takeaway is, look, people are always buying and selling. The right time to buy or sell is when it's the right time for you. So we as professionals need to be educated, need to understand that I think we're hovering in between the high 6s to mid 7s as far as interest rates. That's the new norm. It's not a bad thing. Take opportunities for potentially lower prices depending on where you are, right, in the country. And that's the approach that you have to be taking with people. It's not a bad time to buy. Be educated in your decision and move forward from there. But it's going to be really interesting to watch if we're going to get this September cut. And a lot of it's going to be in the next couple of weeks coming up. We got all that job data, and then the following week we got all that inflation data. So going back to our theme, right? How do we move more homes? So I've been doing property tours, and I've been partnering with a title company here locally, and it's really easy, right? Send out an email, a bunch of people want to show their houses, and it's great because it does a couple things. Not only do you get to meet great people, it's really cool to get around an environment where everyone is beating to the same drum. And that drum is, hey, help me sell my house. Help me help my clients. Tell me what I can do differently that might be able to move this product. How can it be more attractive? And the biggest thing that I see, and it's not typical, well, I do see it in even new construction houses. Look, think about it. When you walk into a house and you see it for the first time, one of the first things I notice is the cleanliness of the house. I notice it right out the gate. And if you think about it, even if you walk into a dated house, a house that's in the 80s, a house that's in the 90s, but it is meticulous, one of the first things you say to yourself is, wow, this homeowner really took care of this house. And it leads you to believe that they took care of it the whole time. They did the upgrades that were necessary. There's no faults in any structure. There's no electrical issues. It gives you a very easy feeling. On the flip side of that, think about walking into a house that's been, moderately updated or even well updated, and it's filthy. You got dust all along baseboards. You got stuff all over the house. It just looks, it gives you that feel of it's dirty, it's dark, right? Immediately, what do you say to yourself? The client didn't take care of it. And are they asking too much for this house? I mean, there's going to be a lot more that I need to do to this house. And here's the beauty of it. And that's why I said it needs to shine. Everybody can do a deep clean to their house, right? Even as real estate agents, if our clients won't do it, we know somebody that will do it, and it's very inexpensive. It needs to shine. In an extremely competitive market like we're in right now, you need every advantage you can get. And on some of these recent property tours that have been going on, I can clearly tell you that some of the houses out there that, great houses, they look beautiful on the outside. You get on the inside, to me, that's one of the most glaring things. Clients are extremely picky right now. They're looking at any potential waves and walls. They want the best product out there when they're dropping top dollar. Remember, it is the biggest asset 99% of the population is ever going to buy. And they're having to pay over 7% for that asset right now. That's expensive money. It's not cheap. It eats up a great percentage of their monthly income, annual income, and they want to make sure that that house has the value that they're paying for it. And I think the easiest thing to do is do those deep cleans. I see a lot of houses. I see a lot of houses all the time, and I would argue that 80% of them do not have that deep clean touch. So that would be my best advice out there. You want a competitive advantage, you'll stand out to a majority of the marketplace by just doing a deep clean. All right, everybody, have a great week. We're in a short week, right? I'm coming to you now on Wednesday. This is my Tuesday. So it's a short week. What I anticipate rates to rise this week with the big jobs data coming next week, the total uncertainty with where inflation is going. Remember, the Fed needs months of good data points to actually decrease. So that just keeps getting pushed out, where the Fed might potentially do a Fed funds rate cut. And remember, now all roads are leading to inflation. So any data points, any data sets that are coming out, whether it's growth, whether it's the consumer, whether it's jobs, doesn't matter what it is, it's all going to where, what does that mean to inflation? Do we see a path where the Fed is going to be able to decrease the Fed funds rate and we're going to get to that anticipated 2%? All right. Have a great week. I'm around. You need anything, I'm here for you. Happy selling. Talk to you soon. Cheers.